Okay, we'll go ahead and get started. Welcome, everybody. This is Nathan Lee. I lead the advisory practice, the mortgage banking advisory practice here at Richey May. It's good to be with you all. Thank you all for taking some time out of your day and joining us today. I don't know if it's just me, but it seems like the last one of these quarterly webinars we did was just last week. So I don't know what happened to the last quarter, but time is flying here this year. So thanks for carving out a little bit of time. And we hope that the information that we share with you today is going to be valuable and that you'll get some insights from the things that that have been prepared and that will be shared with you by a few members of the team here. So just by way of background, for those of you that aren't familiar with the firm, Richey May has been specialized in the mortgage industry for many years and serve 275 or so mortgage companies around the country across audit, tax, and in a number of advisory areas in compliance and operations, technology with business intelligence, data analytics, cybersecurity, automation, and a number of other things. We started the trend series, the quarterly trend series webinars now a couple of years ago and been doing this for a little while. And we always work together here on our side to come up with some topics that we think are relevant, timely, based on what's going on in the industry. There's obviously a lot going on in the industry right now, and so it's difficult to touch on all of those things, but we try to bring a few things to the surface, share some insights that we glean from working with a lot of companies across the country and seeing some things that are done well, some things that are not so well, and share those with clients, and doing it in this kind of a format where we can share it out with a lot of our clients and friends all at once, has been very effective. And so appreciate you again spending some time with us, and all of you are on mute. We'll have some time at the end for some Q&A, and if you want to come off mute at that point, you will be able to, and you could ask your question in that form. Otherwise, you could also put it in the chat feature in the GoToMeeting app, and those questions will come to us, and we'll make sure that we field those and respond to at least as many of them as we can here today. If there are any that we aren't able to get to, we'll follow up on those individually after the fact. The webinar is going to be recorded as well, and we'll send a recording out afterwards to all those that are participating today. And so we'll go ahead and get things kicked off. We're going to cover a number of things today. We're going to cover some data trends. We share every quarter some information from the most recently finished quarter that we have data for. So we're going to share some of that data with you all so that you can see some of the quarter-over-quarter and year-over-year trends. Many of you have heard some of this or hear at least anecdotally some of this from quarterly reports from the now public companies and from other sources, but we'll share a good cross-section data from a cross-section of independent lenders around the country that is representative of I think what is actually happening out there. We'll talk about some items related to servicing and the impact that the current valuations are having, and some things that can be done to deal with that. And that will dovetail into some things that we'll cover around managing profitability and cash, and addressing some important compliance related issues that you need to be aware of and thinking of here as you approach the end of the year. And then we'll also cover some tax planning considerations that are going to be important here for you to be aware of and thinking about as you finish out the year as well. So with that, I just want to introduce briefly the people that are on the webinar today and are going to be presenting. We'll start with Olivia Nicholson, who leads the business intelligence and data analytics practice here at the firm. and she'll be sharing some data insights gleaned from our Richey May Select benchmarking data. And then we'll also hear from Seth Sprague today, who leads our mortgage banking consulting practice, and he'll cover a number of things, including some of the servicing related items. And then we'll also be hearing today from Jennifer Hanna, who leads the mortgage banking audit practice here at Richey May. And finally, we'll hear from Jared Frost, who leads the mortgage banking tax practice, who will share some tax considerations for you to be thinking about. So glad to have them with us today. This is a great group of panelists, and I'll hand things over to Olivia to go ahead and get started.
Great. Well, thank you, Nathan, and thanks, obviously, everyone for joining today. I was going to say exactly what Nathan said. I felt like as I was preparing that we just did this a couple weeks ago, but somehow a quarter has already gone by, so time to jump in again. Like Nathan said, I'm Olivia. I'm going to be showing you some reporting today from our Richey May Select benchmarking program. This is our quarterly financial benchmarking program, and we've had this going on for about 10 years now. We have about 80 IMB participants in the program, so I definitely have some robust data I'm going to be able to show you. You can see some trends that we're seeing in that data as of the close of Q2 of this year. As always, I'm going to start by showing you some origination trends and then move on to the financials. I'm going to go over our net income and net production income figures, along with the key drivers, including gain on sale and cost to originate trends. And just to clarify before I get started, all of the data I'm going to be showing you today is on the entire Richey May Select population. So these averages are really coming from, a mix of different lenders. They're intended to show you a trend, but just keep in mind when you're comparing these numbers to your own internal numbers, it's obviously not going to be an exact match, just depending on your size or your channel mix, geography, any of those different factors in there. So starting off with our origination trends, for this report, I'm just showing you a view of the last 5 years. So we're starting, you can see back to the beginning of 2017. You can see here Q2 2022 volume dropped 13% from Q1, and that was a 40% drop from the same quarter, Q2 of last year, and actually a 49% drop from our peak quarter, which was Q4 of 2020. So we are now we've cut our quarterly production by about half compared to that peak that we saw at the end of 2020. The other trend I want to point out here is that we did in fact have an increase in total purchase production. You can see that blue bar increased a little bit over the quarter. I know heading into Q2, we were concerned a little bit about heading into purchase season, what was going to happen there. We'll definitely hear Seth talk in depth about this in a few minutes, but we did at least see some marginal increases in purchase production. And with this increase in total dollar purchase production on average, lender by lender, we saw the purchase share go up to about 85% on average this quarter. Obviously, on the flip side of that, it means that the refi share dropped to 15%. This is one of the lowest refi shares that we've seen throughout the benchmarking program's history. So like I said, the last 10 years. And the last time we saw these levels were around 2018 or 2019. And then another production trend that I wanted to touch on this next slide, just to point out here, because I just wanted to give you an update since we did cover this last quarter. This is changes in ARM production. So this is showing you the average ARM volume as a percentage of total production for each client back to 2012. You can see we had a big jump this quarter that brings us close to a high, the highest level, as you can see, since 2014. That being said, this is an average percentage of production across lenders, so lender by lender average. So this is more so a result of a subset of lenders, I would say about a quarter of participants in the program with significant ARM production, and more importantly, with significant increases in their ARM production quarter over quarter. So I know when we're talking about averages, like I have on this slide, we don't want to be misled to the wrong takeaway. So definitely the headline I want you to grab here is that there are some lenders who have decided or really been able to boost their ARM production over the quarter. But for the larger population, that percentage still remains fairly low. So it's just that the population that is focusing on ARMs is doing so enough to pull that average up for this percentage, which is meaningful. to pay attention to, but is not an indication that all lenders have increased their ARM production by this much. So those are our production trends for the quarter. I can move on to financials. So starting with our net income numbers. So the refresher I always like to give here, especially for this comparison graph on net production income and GAAP net income, is that the net production income figure is intended to give you an apples to apples comparison on your origination platform profitability. So this excludes any servicing income, expenses, or adjustments. It also excludes your unfunded locked pipeline, just to smooth out some of the differences each quarter on your unrealized pipeline. And we're also removing from this your loan loss reserves or any outside activity or investments that are not related to originations. So that's one side is our net production income. The other side is GAAP net income, which is basically just what you would see on your audited income statement, which obviously includes all of those line items I just detailed that are being excluded from your net production income. So as you can see on this graph, the net production income figure is the green bars, and then the GAAP net income is the blue line that we have overlaid there. The first thing I'll point out here, and the reason I have both of these numbers included on this chart this quarter, is to show you, if you remember from last quarter, we had a unique situation where that GAAP net income was positive, but our origination profitability was negative. And as we discussed last quarter, that was the result of servicing profitability as well as unrealized gains on open locks. So that was creating that 80 basis point gap we had between the two income numbers. You can see that this quarter, that gap really closed. Both numbers are above zero, so that's good. We're profitable from both perspectives. And the close in that gap this quarter was really the offset of servicing versus IRLC numbers. So MSR portfolio is definitely appreciated over the quarter, as you'll hear Seth talk about in a minute here, but that was offset by the unrealized losses on locked pipelines for the quarter. So those two kind of net out to a difference of only 5 basis points between the two net income numbers that I have shown here. So as far as actual numbers here on the income side, I'll highlight the net production income number, which increased 43 basis points this quarter. This is still a 78% drop from this quarter last year, but the good news here is that after last quarter, we're at least obviously back to profitable. So we have a 16% break-even surplus volume, which is up obviously from the 9% deficit that we saw last quarter. So now digging one layer deeper from total profitability into some of the metrics deriving that, starting with secondary gain on sale. What I'm showing here is the net production income gain on sale figure. So remember that this excludes the unfunded locked pipeline gain or loss quarter over quarter. So just keep that in the back of your mind, and also remembering this is an average of all of our Richey May Select participants. So not specific to any particular size or channel mix of lender. So your internal numbers might not match, so definitely be a little bit different here. So on average, we actually saw a slight increase in the gain on sale figure this quarter. It was up 17.5 basis points from last quarter, which was a 6% increase. You can also see we backed off a little bit from that historical low that we were matching last quarter from back to 2013. So that's good news. We're still on the low side, but back in line with some of the levels that we saw in 2018 and 2019. So that gives us an idea on the revenue side. Moving on to the other side with expenses, looking at cost to originate. Q2 cost to originate went up about $200 per loan, which was a 2% increase. So not a huge jump, but definitely continues to tick up further and further. We have been at historical highs for a while now, so really any increase here is just pushing us further into those highs. There was a decrease in the back office category here, which was a result of a small drop in corporate and benefits expense categories this quarter. But we saw per loan increases in all other department and line item categories. I have the percentages laid out here on this slide. Sales went up by about 3%, fulfillment by 9%, and then ops overhead expenses by 4% per loan. And just a quick note here on that back office figure, although it did drop slightly, so you see that negative 3% quarter over quarter, you may remember from last quarter that it increased by 28%. So Q4 of 2021 to Q1 of 2022 was a 28% increase. So even though it decreased a little bit this quarter, if we're looking at, all in so far this year, that back office expense has still gone up considerably. So that wraps up the trends on the benchmarking side I wanted to show for this quarter. I'm going to go ahead and pass it over to Seth to dive a little bit deeper into the purchase market and MSR trends.
Thanks, Olivia, and great information as always. And I would say that those cost numbers are a little shocking considering the number of rounds of layoffs that we've occurred, but maybe those are front-loaded expenses that we'll see sort of those run rate of expenses decline over the next couple of quarters. But if we go to the next slide, let's kind of walk through kind of the purchase and refinance market and kind of what we're seeing here as far as trends. And then we'll talk a little bit more about sort of what's going on in the servicing space. So if you go to the next slide, Olivia, we're going to look at sort of the purchase market and where we are or where we aren't. And I guess the punchline here is that, mortgage rates have been volatile. Mortgage rates did actually fall below 5% per the Freddie Mac survey. Let's face it, the Fed, I think, has raised rates 150 basis points since we've last met, and mortgage rates have actually come down a little bit. Now, they've been volatile, and they're kind of back up again a little bit, but we may have hit the peak of mortgage rates for 2022, maybe not. But the general thought process is that inflation's a little bit better controlled. It wasn't a surprise to the high side, and that has caused continued volatility. And as you think about this volatility, I think it bears out in some of the Richey May Select data. That those hedging costs are just elevated at this point on your pipeline side, and if you hedge MSRs, they're also elevated. So that performance kind of through the secondary market and kind of sort of the volatility of rates and what's the current coupon sort of remains a challenge out there in the industry. So again, this is just a view of the mortgage rates. If we go to the next slide, slide 15, I guess, this is the purchase market. I guess the punchline here is that if the 22 purchase market feels different than 20, 21, or 20, it is. You can see that the blue line here is very much lagging the red line or sort of the charcoal gray line, with the exception of what occurred in 2020 with COVID. And so while the purchase market is better and it remains strong, this is the index. And one thing to always consider as we're starting to compare years, it's particularly volume numbers, is that housing has appreciated, let's say conservatively 15% over the last 2 years annually. And so while the dollars may not look as weak as they are, the units are certainly weaker. You're producing less units than you were, and that is having a real impact on your operational efficiencies and your back office expenses as you're generating less units, even though the dollars are down. They're not down as much as you would expect because of the housing appreciation. So the purchase market, sadly, not as strong this year. It's not even up to 2019 levels as part of this index suggests. And if we go to the more depressing news on the next slide, which will be the refinance, it's kind of flatlining. So if this was a doctor show and we were patients, we'd be flatlining at this point. They'd be getting the crash cart out for us to try to resuscitate refinances. On the refinance side, I'll make this comment. Depending on where mortgage rates end up, you're starting to see, or there's been a couple hints that some of the 2022 production that's at those high coupons, above 5.5%, will refinance as soon as they can get to lower rates, but nothing materially moving the needle. And there are still some cash out refinances that are occurring by borrowers. So they don't qualify for HELOC, or they're not interested in a HELOC, or they're interested in getting cash out. There is still some refinance activity, but boy, it's fallen below 2019 levels and well below any of these other indexes. So again, tough times in the refinance market for sure. If we go to the next slide, we're going to talk about some MSR trends. This is an 8-bank average of MSR values over time, and just so we level set, and if somebody doesn't have their portfolio at 140 basis points or 120 basis points, whatever. Remember, this is a measurement of the percentage of the value divided by the UPB. This does not reflect multiples. It does not reflect different service fee levels. So again, these are banks. Banks tend to have servicing portfolios generically that are kind of around a 30 basis point strip. Some of them are a little higher than that, some are a little bit lower, but remember, banks tend to create more MBS securities where they could create a higher than 25 basis point servicing strip. And banks still do have some Ginnie Mae servicing, which may not be at 25, which may be all over the place when it comes to servicing fee levels, including some legacy servicing that might be at 44 basis points. So again, values are up from a valuation standpoint. And these are actually the highest levels that we've seen since the pre the Great Recession. Overall, most of the companies are valuing servicing north of a 5 multiple or of servicing fee. Many companies are, and those are the highest multiples we've seen in a long time. So, you know, from a balance sheet perspective or from a fair value perspective, values are up. If we go to the next slide, the market trends are going to tell us a slightly different story. For those that listened to the Citus webinar last week, you know, they're talking about there's now a gap between the fair value and where a bid will come in. The indications are from the buy side demand, you know, values have actually declined. And so this is going to create an interesting confluence of events as we go through the third and fourth quarter of this year, where, you know, those values are, it's a level 3 asset. They're supported by the assumptions, but ultimately those values that are being ascribed on the balance sheets may not be attainable in the MSR market. Some of the MSR buyers are full, and so they're just not, you know, interested in bringing on servicing, or they're going to bring on, if they're going to bring on more servicing, they're going to hit it with a higher yield, which will be a lower value. There's been just, you know, the overall economic conditions, while inflation may or may not be sort of contained at 8.4%, you know, counterparty risk, recession fears, FHA MIP changes, which I'm going to probably take off the list because it hasn't happened, which means it might happen, who knows. And for those that have retained servicing and you kind of represent a one-time seller, right? You've aggregated servicing to some degree. You want to get out of that servicing position. The one-time sellers are not viewed as tremendous counterparties by a majority of the buyers because it's a kind of a one and done deal, and they're looking for a relationship. So again, all those are reasons why the buy side has weakened, and weakened materially from June 30th. The deal flows have certainly slowed down, and at some levels, Ginnie Mae servicing right now is pretty unliquid with a very small number of potential buyers out there. So the market trends speak to kind of a market that's sort of dysfunctional right now, despite the fact that it should be a much better time to trade servicing. It's actually a lot of challenges in this space. So if you're holding servicing or you're contemplating a strategic sale this year, I would strongly recommend you talk to your advisor in that space and make sure that you understand where the trading levels are versus where you have where you may have the portfolio marked. I go to the next slide, Olivia. So takeaways, I think we teased this as 5 takeaways, so I'm going to attempt to cover 3 of them. I know my audit and tax partners here will cover at least 2 more, so we could at least cover the 5. But having been on the road recently and a number of clients, whatever your break-even analysis or profitability metrics were that you were using in June, probably you need to adjust them in July, and you're probably adjusting them again in August. So understand kind of what that break-even analysis looks like going forward. As we charge towards year end and charge towards another quarter end, warehouse lenders are going to look at covenants. They're going to want to see how you're going to be profitable. There is a lot of, you know, obviously staff reduction going on out there in the industry, but you want to make sure that you can meet those profitability levels. So understand profitability with your current level of production. Equally, as you can see in the marketplace, you could see announcements where Loan Depot is exiting its third-party originations. The latest rumor from Bloomberg, unnamed sources, is that Wells Fargo may be reducing its correspondent channel. Others have exited, like Finance of America has gotten out of the consumer direct channel. And so, again, entities are evaluating channels and profitability and break evens. And so, again, probably another time to run another forecast. I guess if there's some good news here, the most recent activity probably points to the fact that 2023 is a year where we're probably not going to overestimate mortgage production and mortgage earnings. And it might be a year where we actually exceed it because of the recent activity. You might be able, as you go through your budget season, be able to support sort of, it's not going to be a great year for a mortgage, and you'd have less time explaining those variances, which is always helpful. On the con to that, make sure you're running, I would say, performing scenario analysis. I think this is critical. Citus mentioned this on their call on the MSR side, and I'm going to mention this on the production side. You know, what if mortgage rates close the year at 475 or hit 475 in the first quarter of next year, right? What if they hit 6%? So understand where those different break evens, those different scenarios are. If you need help with that, certainly the folks here at Richey May can help. And then the final kind of takeaway for the remainder of 2022 is that if you have retained servicing, and I know I mentioned this last time, but make sure you understand the true cash flows that you're getting from servicing. Escrow earnings rates, for example, on taxes and insurance are way up due to the Fed activity on the short end of the curve, but they're actually earning that money. If you're not a bank, the answer is probably no. So understanding the difference between what's in your fair value of your MSR asset cash flows and what's in your true P&L, I think is more critical than ever. And actually, I've been spending a fair amount of time across a number of clients trying to help walk them through that. That difference doesn't mean that you've made a bad decision to retain servicing. It doesn't mean you made a good decision to sell servicing. But understanding that gap and understanding how that servicing fits within your overall strategy, I think, is the key element going forward. And again, there's people that are still trying to get into servicing, and there's still people trying to get out of servicing. So that, as always, there's really no consensus in the industry as to where you're going. It's how does it fit within your overall strategy as a mortgage banker. I think with that, Olivia, I think that kind of concludes my slides, and I will turn it over to Jennifer Hanna, who runs our audit team here.
Hello, there we go. So just to kind of piggyback a little bit off of what Seth and Olivia have already lined up, just what's happening with the mortgage industry, what's happening with potential year-end audit impacts. The first thing would be Richey May is going to be sending out to their audit clients a going concern analysis. It's going to be a quick questionnaire, and then if you have some kind of projection for 2023 that you could share with us. This is nothing to, it's kind of like our fraud inquiry. It's a check the box to make sure, you know, we've asked the appropriate questions to you all, that there is a plan to get through 2023. I don't want to spook anyone on the phone call. There are, you know, I think most of our clients are doing fine. It's more to just make sure that there's a plan in place to get through 12 months after the audit report date to make sure there's no potential issues that we have to address. With that, market conditions and just how that impacts your loan loss reserve. Did you have a massive EBO sale in 2021, 2022 that would impact your loan loss reserve? You know, zeroing in on that number to see what kind of delinquency rates do you have in your, or delinquency percentages do you have in your servicing portfolio? Just anything that could potentially impact that reserve. That seems to be a lot of questions that we're getting from clients. To piggyback off of that, CECL has to be implemented for private companies starting next year. So we are going to put out a webinar on CECL, the impacts to IMB, and also some discussion on modeling options, so people are ready and prepared for that as well. We've had 2 webinars, one in June and one, I think, 8/2 on leases and the accounting for that. If that's something that's not on your radar, just make sure that that's a pretty big uplift in what you have to, you're basically taking all those leases, putting them on your balance sheet if they're long-term. There's a significant amount of calculation and data and detail that goes into it. Most of our clients are ready, they have a plan in place. The majority of them are using outside vendors. Some of them are trying to do it in Excel. Just keep that in mind, that if that's not high on your priority list, you might want to move that up a little bit higher, just because the clock is ticking and it's not a quick implementation. Another thing on a somewhat negative note, net worth, HUD net worth reporting requirements. If you have a loss or your HUD net worth has gone down more than 20%, there's a requirement to report that to HUD and come up with kind of a plan on how you're going to mitigate the changes in your net worth and your loss number. So just keep that in mind. We'll send out, when they're due, we'll continue to send out like marketing emails kind of explaining what you need to do with that. Another thing, if you're in a little bit of a bind and you're having to put in a capital contribution at year end to meet, hopefully not net worth, but potential liquidity requirements, just keep in mind when you contribute that capital into your company to leave it in there. The intent of a capital contribution is to put it in the company and leave it for a period of time. Please don't put it in at year end and then distribute it a week, 2-3 weeks right before the audit, just to get that cash in at year end. We would need to pay attention to that and potentially show that as a loan and not necessarily a capital contribution. A couple of other things that are not on this list that I thought would be helpful to pay attention to is just year-end warehouse covenants. If you're missing a net loss requirement or something like that, just be thoughtful to get waivers for the audit teams. That's something that, as you run those calculations, if you're missing a covenant, reach out to the banks and get a waiver for Richey May so we can make sure that we're comfortable with that. A couple of other things that are not on this list, just the year-end pipeline report. Just be thoughtful because of everything that's happening in the mortgage industry right now. Just be really thoughtful about that cost to originate. Is that truly what cost you're incurring to originate this loan, or does that need to be tweaked at year end for any exits of branches, inflows of branches? And then just paying attention to the investors that the loans are being priced to. Are they still viable investors for your pipeline and how you're valuing that? So just a couple of things to think of. If you have any questions on leases, reach out to your audit team. They'd be happy to assist, answer any questions you may have. CECL will have a webinar coming shortly on that. And then we're also going to have something on just year-end audit prep where we'll go over some of these topics and a bunch of additional things in a lot more detail. Take an hour to go through everything. But that's all I have. Thank you.
All right, and now that now we got all those boring topics out of the way, we can talk about the most interesting one on this call, which is tax, right? Oh, maybe it's just me. So again, to piggyback off of what Seth was talking about, MSR sales are certainly something that a lot of folks are considering right now. Is it the right time? That's more of a global business decision, lots of factors to consider. But there are certainly some tax advantages to selling MSRs, the biggest one of which is that in most cases, in general, there's the opportunity to get a pretty substantial capital gain treatment on the sale of those MSRs. And if you've held those MSRs for at least 1 year, you can get long-term capital gain treatment, which comes with a preferential rate. So certainly something to consider as you're looking at your MSR portfolio and whether or not you want to sell them this year. Just to highlight that a little bit further, ordinary rates are scheduled to go back up in 2026 as part of the Trump Act that was passed back in 2017. The rates and brackets that are currently in place are scheduled to sunset in 25, and so in 2026 they're going to go back to the rates that were in place prior to the Trump Act. There's obviously also been a lot of talk around the capital gains rate recently, and nothing was passed and nothing's scheduled to be passed, and it doesn't look like anything will be passed here in the next couple of years, most likely. But that's always, potentially on the horizon, that Congress, as it looks for ways to increase taxes, that they may look at that capital gains rate and increase that. So again, not a short-term concern, but something to just think about. Another thing that we've been hearing a lot from our clients on are compensation strategies. Mortgage bankers are always looking for ways to attract and retain talented LOs and key executives. And so using some equity-based plans or deferred comp plans might be a way to help retain that talent. I would say there's no one size fits all here, depending on what you're trying to accomplish. There's lots of different alternatives and lots of different ways to structure these. But in general, I would say that the equity-based plans are used more to attract and retain key executives, and deferred comp plans are used more to maybe attract and retain good LOs. So again, not a hard and fast rule. You can use both in both scenarios. I was talking to a client the other day, and they did make the comment that LOs don't really seem to appreciate deferred compensation. they want their comp now, and I thought that was an interesting insight. So depending on who you're dealing with, that may or may not work, but something that certainly a lot of mortgage bankers are looking at considering at this time. M&A activity, obviously transactions are still happening, given the market conditions here, especially this year, kind of coming out of that boom from 2020 and 2021. People are certainly looking to sell their mortgage companies, and those who are there are certainly those in the marketplace that are looking to buy as well. So transactions are certainly happening, and there's obviously lots of tax consequences to consider in that. And so whether you're on the buy side or the sell side, certainly lots of tax considerations in that process. And then finally, or maybe finally, tax planning. Certainly, where the market is today, lots of people want to understand their tax position, and are there things that they can do to improve their position. And one of the questions that we asked here recently is, do I need tax planning even if I'm in a loss position this year? And we published, some information online about this. And the answer is certainly yes. There are things that you can do even if your mortgage company is losing money to try and maximize the benefit of that loss. And it's kind of the opposite thinking of what you would normally think about doing in a situation where you have income. So when you're in a loss position, you may want to look for ways to actually increase your income in the current year. Are there things that you can do to accelerate income that may otherwise be postponed into a future year into the current year? Also, are there ways to defer expenses? So things that would normally be expensed in the current year, can I defer it out into 2023 or some future period? And again, that would just be a way to maximize the benefit of the loss in the current year, is to try and accelerate income or defer expenses. And by doing that, it puts you perhaps in a better situation in 2023, if you will be in an income situation in that year, to where you might have additional expenses or less income in that year that would be taxable. So that's, basically then in a nutshell, that's kind of what we talked about in the white paper that we sent out here a month or so ago, is looking at, strategies or ways that you might be able to accelerate income into the current year and or defer expenses into a subsequent year. I know not everybody's in a loss position, and certainly if you are in an income position, then there are, the opposite would be true. Are there ways to defer income or accelerate expenses to try and reduce that income in the current year? I know lots of you on this call are probably interested to hear a little bit more about what's going on with this Inflation Reduction Act that just passed, the Senate and House last week and was signed by the President yesterday. Really, from a tax perspective, there's nothing in there that would directly impact mortgage bankers, or at least not any of you on this call, most likely. Really, there was only two main tax provisions that were part of that act. One is that there's a new 15% minimum corporate tax rate. So again, only for C corporations. But it only applies to corporations that had a 3-year average net income over $1 billion. So I couldn't think of any clients that we have that that would have fallen to that bucket, and I can't imagine many independent mortgage bankers across the country would fall into that bucket. So most likely not applicable. The other one was stock buybacks. They're actually charging a 1% tax when a company buys its own stock back. But that only applies to corporations that are traded on an established exchange. So again, most of our clients, none of our clients I think that I'm aware of are public and traded on an exchange. And so again, probably not applicable to many or any of you on this call. The only other things in that act really are around credits. Most of the credits are in the energy space, so obviously looking to produce reusable energy, and they're offering credits to companies that do that. The credit for EV vehicles is being extended and enhanced, so if you want to go out and buy that Tesla, you should be able to do that and get a nice tax credit as part of this act as well. So that's really all that I can think of that was really in that act, and these are kind of the major trends or things that we're talking to our clients about. So let us know if there's something that we can do to help you as you think about taxes here for the second half of the year. And with that, I'll kick it back over to Nathan, who will wrap up for us.
Great. Thank you, Jared, and thank you, Jennifer, Seth, and Olivia as well. Hope there were some valuable tidbits in there for you guys. Just looking at questions here. And again, and if you have some other questions and haven't submitted them yet, go ahead and submit them through the chat, or feel free to come off of mute. I do have one that was going to go over to Seth. And that is just probably a question that a lot of you are thinking, but it is now a good time to sell servicing or no?
Yeah, so I'll turn that over to Jennifer to answer that. No. So, well, as the tax side says, maybe it's a good time, depending on your income. I would say from a market conditions, it's going to be a bit of a challenge. It's unlikely that you will achieve full fair value at this point on your servicing. That doesn't mean that a sale should be off the table, but you have to understand that you may not be achieving full fair value given the market conditions. That being said, the strategy at this point, and I hate to say it, but the strategy at this point is survive and advance. So, how do we get through the next couple of quarters? How do we get to next summer's hopefully very strong purchase market? And so if there's a cash need or a capital need to sell servicing, then it's worth exploring it. You should run the economics though of what is your true cash that you're going to receive on a post-tax basis, including the capital gains that Jared talked about. Is that available to you? So the answer is it depends on your strategy. From a pure market conditions perspective, the answer is probably no. But from a strategy perspective, the answer is could be yes. So it's really very much client specific. I just, the market conditions could improve here, but we have to think about a couple things. We're sitting here now already in the middle of August, and conservatively, it's 60 days to sort of get agency approval on a sale. So if you're going to contemplate a sale, you probably need to get out into the market in the next 30 to maybe 45 days to make sure that you can get that true sale accounting for the year, if that's the objective. And so it's sort of a small window here where we, hopefully that the market conditions can stabilize a little bit and that you can execute a sale. If you get past sort of October 1st and you haven't sort of gone to market or thought about a sale, then you could definitely maybe not get it in by year end. And I think that would be kind of the worst case scenario, is sort of selling it at sub fair value and not getting sale accounting.
Yeah. So another one that came in, it's fairly specialized area here. I'll kind of pull the panelists here and we'll see if we can, we've got some thoughts here. I'll start with Seth probably, but how is the CRA LMI spec loan pool market right now if you're buying loans? Assuming that question is coming from a bank, I would assume. Again, there are probably several of you on this call, but might be a specialized area there. Seth, any kind of recent color or insight into that?
I'm just going to speak about traditionally rather than kind of specific to the market right now, but typically those always trade at a premium because of the need to hit your LMI or CRA credits. So I would say, generically speaking, that market is probably just as pricey as it usually is this time of year, as people try to ramp up to year end. I do think to some aspect, depending on the LMI, depending on the overall characteristics of that loan and its potential probability of default, I do think that pricing is probably not as strong as it's traditionally been, but the need to hit those CRA requirements is just as strong as ever. And I know that the MBA was fighting this issue, but there's talk that the CRA credit is supposed, that Washington D.C. generically wants independent mortgage bankers to even comply with CRA credits, which, if you think about it, is kind of difficult depending on the mortgage company. It would kind of be a very bad rule, which would really drive up prices in that market. But it's certainly a point of contention. It's going to be a point of interest. And for anyone contemplating M&A activity on the bank side, if you don't have that rating at the appropriate level, they won't approve your trade, whether it's a buy or a sell. So particularly, a buy. So I think you're going to probably see that ramp up. Traditionally, the fourth quarter is when the pricing gets even higher. So if you're in need of it, I try to go grab those loans quicker. And I would be reaching out to the typical correspondents that you might be selling loans to, because those are the ones that usually have a decent pool of those loans to potentially sell.
Great, thanks. Seth, now I've got one that I'm gonna bring Jared in here to answer, and that is, can you speak to the use of R&D credits, research and development credits, for the tech leaning companies on the call? So those, and I'm sure there are plenty of those on the call that have made pretty significant investments into technology over the last few years in an effort to reduce their cost to originate, which, as Olivia pointed out a little bit earlier in the webinar, continue to go up. I know a lot of lenders have focused on the use of technology to try and drive that down and to just improve borrower experience and so on. So Jared, I'll bring you in here and just have you provide just a little bit of information there around the use of R&D credits, whether that's something that has been widespread in the industry, and what we've seen in our work with clients, which I know we've done quite a bit of around that R&D tax credit area.
Yeah, so yes, R&D credits are certainly available to mortgage bankers that are utilizing technology. We don't necessarily specialize in that, but we do have some strategic partners that we partner with that have a lot of expertise in dealing with mortgage bankers around the R&D credits, and can certainly speak to the advantages of utilizing that strategy from a tax perspective. So yes, if you have high spend in the technology area at your company, there's a very good possibility, a good chance that R&D credits will be available to you. I will add that in a act that was passed several years ago, actually, that starting in 2022, R&D expenditures are required to be capitalized rather than expensed in the year incurred. So R&D credits could become even more valuable under that scenario to at least allow you to take a credit for some of those expenses. Again, you probably aren't going to qualify all of your technology spend and all of your research and development expenses for a credit, but at least the credit can minimize the pain now of having to capitalize those expenses and amortize them over either a 5 or 15-year period. The difference being that if the expenses are incurred, if that technology spend is here in the United States, you get to amortize it over a 5-year period. If you're using foreign resources to assist in your research and development efforts, you have to amortize those costs over a 15-year period. So, certainly something to keep in mind here starting in 2022 with respect to research and development expenditures.
Great, thanks, Jared. One comment that came in, so shout out to somebody that is on the call. Shout out and thanks to Keith. Good to see you, Keith. Glad you were able to join today. But he mentioned that Massachusetts licensed lenders are already subject to Massachusetts CRA regs, and even includes a separate audit. So I think that just in follow-up to the comments that Seth was making here just a couple minutes ago about those CRA rules and the potential applicability here to IMBs in the near term. So appreciate, Keith, you bringing that up and pointing out that that is in fact already in place in Massachusetts. Any other questions? There's another comment here coming in that apparently that is the case also in Illinois. So if we stay on the call any longer, that list of states might keep growing. So it's at least Massachusetts, Illinois. There may very well be others. Usually, if those states are leading out on something like that, California is not far behind. So if California doesn't have one already, there's a decent chance it probably will at some point. So. Anyways, with that, are there any other questions that anybody has and wanted to come off mute and ask, or any others that you want to try and drop in here last minute in the chat? Go ahead and do so. We've got another minute or two if you want to just try and get a last minute question in. Okay. Well, then I will take that as no. If we see any come in here through the chat over the next few minutes before the webinar ends, we'll be sure to respond to those individually. And so by all means, go ahead and send any others off that you have. There'll also be some contact information. I believe here on the next slide is there some contact info. There is. So if you have some other questions, feel free to shoot them to that info@richeymay.com email address. We'll make sure that it gets the right person here and we get a response back to you. So if you don't quite make it into the chat function there, shoot us an email and we'll be sure to get back to you. So again, thank you all for joining. As a reminder, we are going to be holding a webinar on the 30th of this month to dive a little bit deeper into things that you can do to prepare for audit and tax season, to make sure that you can have a seamless and as smooth an audit and tax preparation compliance process as possible. So look for that invitation. There'll probably be another 1 or 2 invitations going out. So if you haven't seen it yet, haven't been able to register, look for that. And we'll have that webinar coming up in a couple weeks. And we'll send the recording of this webinar out here in the next day or 2. And there will be a survey as you're logging off from GoToWebinar. And if you wouldn't mind just taking a minute, I think it's a couple questions, shouldn't take you more than 30 seconds or so to respond to it. It would be greatly appreciated. Give us some feedback as we continue to ensure that we're delivering valuable, meaningful content to you guys in these webinars. So again, thank you all for joining today and spending a little bit of time with us. It's always great to be with you and be able to share some thoughts. So have a wonderful rest of your day. Let us know if you have any questions or anything that we can do to help. And all the best to all of you. Take care.